guest today is Andrew Papageorgiou, Managing Partner at Realm Investment House, a specialised money manager focused on fixed income markets, overseeing in excess of $1 billion of investor money. Andrew has decades of experience in this sector and directly advising some of Australia's wealthiest families. Currently, Andrew runs the corporate credit and bank capital function within Realm. Andrew, welcome. Good morning. Thanks for joining me today.
Thank you, Robert. Pleasure to be here.
The Reserve Bank cut rates to an absolutely historic low, and we titled this particular conversation, It's a New World. And I think it is a very new world because this is something that we and investors have never had to confront before. And there is a massive conundrum as to what investors do with their money, whether they're being punished by holding cash at bank. Some say that it is probably better off by putting it under the mattress. Who knows? But quantitative easing was talked about by the Reserve Bank. What is it? And can you please explain to us the mechanics of that and what is going on? Because we have heard of it talked globally for many years, but can we talk about the Australian market and what it means, Andrew?
Yeah, no, sure. So look, whether it's in Australia or anywhere else, essentially it's the same thing. It's where your central bank starts buying stuff. Okay, it starts buying stuff because essentially interest rates just don't do the trick anymore because they get so low that interest rate changes or movements down, I should say. So when interest rates get cut, just doesn't really motivate people to do a heck of a lot and doesn't necessarily increase confidence materially. So what ends up having to happen then is the central banks need to go the next step. And the way they go the next step initially, and this is, we say it's unprecedented. It's unprecedented in Australia, but we're talking about a really well-worn path that a lot of people would argue started in Japan in the early 90s and continues in various forms to today. So, what happens initially is you cut rates down to nothing. Then the next thing you've got to do is you've got to convince publics that rates are going to stay there. So what the central bank starts to do is it starts to buy government bonds. Initially, they buy them at 2 and 3 years. And then they start, as they have announced more recently, start to buy or commit to buying government bonds that are longer in duration or longer maturity. So
Andrew, can you just explain, though, when you talk about buying government bonds, how does the Reserve Bank actually do that? Do they give money to the government? Do they buy it through a secondary market? How does it actually work? Can you explain that for us, please?
Yeah, there's no bags of cash that change hands, just all ones and zeros on the screen, right? Like the essentially what you're doing is, this was initially when the Federal Reserve started doing this. The key thing was money printing was the term that gets used, which makes one sort of think about money physically getting printed, but in reality, we all know, of course, that these are just digits in a screen that appear and disappear and can get created and can get cancelled, right? So essentially what the Reserve Bank does is prints money for the purpose of buying the Commonwealth Government or the Treasury, the Commonwealth of Australia's debt. Okay, so essentially what you have is the balance sheet of the Reserve Bank increases in size to accommodate the purchase of that debt. That debt remains there. I mean, that debt, just because the RBA owns the government's debt doesn't mean that debt disappears. Okay, but so essentially what you've got is you've got a liability on the government balance sheet. You've got an asset on the balance sheet of the Reserve Bank of Australia. And, the mechanics of it are there to say, hey, you know what, we're going to keep buying this bond out here. So your expectations around interest rate expectations long term can decline or should go down because we're not going to let it blow out. We're going to keep it within a certain range. And then that trickles down into various other areas. Well, that's the expectation. And most of it is directed at increasing confidence today. Okay, because if you could start to feel like you're not going to get a nasty surprise in your profit and loss statement or your interest payments aren't going to explode higher, it starts to give you a bit more confidence in committing to large-scale capital expenditure, for example, where the way these assets are generally valued is on a calculation known as a net present value calculation, which essentially measures all future cash flows. Okay, so as soon as your borrowing rate for the long term decreases, the net present value today of those future cash flows gets higher for these really big investments. So one of the things that it looks to drive is investment, is confidence and comfort that you can carry a bit more debt. We're not going to pull out the rug from under you. So, and that's what the TFF was initially when the government, the term funding facility, when the government started talking about lending money to banks at the cash rate. That was sort of similar again. It was saying, hey, everyone, you're going to be fine for the next 3 years. There's nothing going on here. So that's what you can see, the natural progression. You get to the point where rates aren't doing much, then you tell people the next 3 years you've got nothing to worry about, and then now, okay, you're probably right for the next 10, and...
the most recent commentary was previously up to 3 years, because that's typically where people sort of fix mortgages and whatnot. So that's what the Reserve Bank was targeting. And then you've got 5 to 10 years trying to give people some assurance or reassurance that even beyond the 3 years that rates are going to stay relatively low. Look, what happens after that? What's the next thing? The Reserve Bank talk about having a number of tools in their toolbox. Negative rates gets thrown around quite a bit in the media, and we hear and read about a lot of that. But you said before that the first thing they do is try and assure consumers through commentary. The second is through cutting interest rates, which they also did a couple of weeks back now. And then it was bond buying up to 3 years, 5 years, 10 years. What's beyond that, Andrew? What else does the Reserve Bank have?
If you assume that this is a road that once you start walking on it, there is only one way, you end up buying everything.
Do you believe that? Do you believe that's the case?
Well, of course it's the case, because in Japan they do. They're in some cases, central banks can dominate the free float of equity and credit, where they totally disrupt and destroy those markets in many ways. So, the US now, we've got the Federal Reserve are buying IG corporate credit. They're buying ETFs. So, that was a step that would have been thought of as unthinkable, 5-10 years ago, let's say. The ECB did it in 2016. They started buying corporate bonds as commodity markets turmoiled, and there were renewed concerns around European viability. And that was used to bail out at the time companies like Glencore and Anglo American that were really struggling on the back of a weakening China picture. In Japan, we've said it, they buy everything there. It's just they buy equities there, they buy they buy credit, they buy their bonds, they yield target. So the question is, once you start on this road, how do you get off it? And what we've seen is the markets are very, very good at punishing any inclination central bankers might have to normalise whatever that means. So it's a slippery slope. Once you're here, how do you back your way out of it? So you think about interest rates, right? If they were to cut from 10 basis points to 5 basis points next month, for argument's sake, I think we all agree that it would do little or next to nothing. What if they increased by 25 points though? What would that do? And that's what we've seen. As soon as people start to feel there could be a tightening, the market hates it. The market goes near panicking, almost panicking.
But history shows us, Andrew, that when rates are rising at these levels, it actually doesn't do much, because the economy is actually warming up and the economy is starting to do well and gaining some traction. It's when rates rise from something like, I think, 4%, between 4% and 6%, when rates start rising is when it really starts hurting consumers in the economy. Is that your point of view, or do you disagree with that?
Not at all. Not at all. I totally disagree with that, because look, the reality is Australians and everyone on earth, unfortunately, we live off our P&L statement. And what that does is it makes you vulnerable, right? And what's happened is, the fact of the matter is that people build their lifestyle around how much they have to pay every month. All right. So even if you can afford to borrow at 3 or 4% when you take out your loan, you're going to build your life around what's left over. And this is how we get ourselves into trouble. So essentially, as soon as rates rise, people need to cut back, and in many cases, materially so. And the impacts are much more significant. They have a bigger impact quicker. And when we talk about history, I would say that, the anomalous environment we find ourselves in post-GFC, where central bank primacy has become almost the only game in town. Let's look at the history of the taper tantrum in 2013. Let's look at the over-tightening of late 2018 and how poorly markets reacted to that. So and then even look at your micro and micro prudential type movements there around, interest only versus investor lending. Any type of impact to liquidity or funding costs, they clearly have a material impact very, very quickly on behaviours. Okay, so I think what that does, it tells you very, very clearly that the ability to allow rates to normalise over a period of time, given the debt load that households hold now, that corporates hold now, that everyone holds now, just very, very simply, serviceability is fine right now because rates are low. You have the ability to impact people's take-home pay, corporate bottom lines, corporate interest coverage ratios. You have the ability to impact them materially if you allowed for rate normalisation. And that's where a lot of people just take the view that, it's not going to happen. And that's why markets, good news is bad news. Think about it. Think about this whole US election where, you've got a lot of people coming out and saying a good result is gridlock. Gridlock's great. We don't want, I'll tell you what, we don't want 2 Democratic wins in the Georgia runoff in January. We don't want that because God knows they'll start to tax and spend, right? And they'll spend big. You can see them veer into theories like modern monetary theory where they really pull the lever and, spill $2.5 trillion into the real economy. And that could actually work at creating inflation, and that would create its own problems. And God knows what that would do to the bond market. Right. So think about the fact that from a market participant standpoint, gridlock is the ideal result. That tells you that rates normalising is not a good thing. It's not a normal thing. It's, let me pick up my university 1994 economic textbook and it tells me everything should be fine. Forget it. That's not, you're not in Kansas anymore.
If we're talking about Japan as an example, and I know this gets thrown around quite a bit, but if our economy is really struggling now, and it's been, I think the recession's the greatest on record, is QE the right answer then to put us in a position where the potential outcome of that could have a far greater impact than what we originally had at the beginning of all of this? I mean, is this the right answer? Josh Frydenberg came out and is talking about the lending requirements and responsible lending and the cooling off of that. Like it appears as though Australia is very aggressively trying to stimulate with whatever resources and tools they can to try and prop up the economy.
I wouldn't read too much into, or as much as has been read into the whole responsible lending stuff. Look, the reality, APRA's lending rules are still there. You're not going to see the banks turn around and create a US property style bubble. So people that have sort of said, look what happened in the US. Tech wreck almost destroyed put their economy in a difficult position. So Greenspan essentially tacitly allowed a property bubble to be blown up that then exploded as subprime lending peaked through 05, 06 and 06. That's not what we're looking to do here. I think the Treasurer has been excellent in picking very well targeted policies. I mean, these guys, they don't have smart missiles. They are, they're dropping bombs in the general vicinity of an area. But if you look at most of the policy that's come out of Treasury, to me, it seems pretty well targeted. So when you look at responsible lending, I think giving bankers the flexibility to deal with, the deferrals from COVID that are coming due on the 1st of April and being able to restructure people in such a way where you might actually have to keep them in a facility that they can only marginally afford. You don't want to create a legal hazard onto the bank for doing its job and helping everyday Australians out. So, there's been no explicit message that that's the purpose either. But I think you've got to balance what was said. I'm not of the view that you've gotten a wink that property speculation is something that they're looking to supercharge and really help. By the same token, there's no question that they want people feeling comfortable about the value of their property. They want people investing in their property. They want people, borrowing as they normally would. But no, I think on the back of what we've learned in the past, I'd be shocked if this is a green light for everyone to pin their ears back and we're all going to look at the other way for the next 2 to 3 years.
Domain just came out with their recent distressed listings tally or table, if you like. Just some rough numbers here. In February, Melbourne was sitting at 0.8% was the rate of distressed listings. In May, it jumped up. It creeped up to 0.9. October down to 0.8. Sydney's sitting at around 1.7%, lower than what it was earlier in the year. What's your take on all of this, Andrew? Given that the Armageddon that everybody had predicted never really eventuated, and we're seeing distressed listings lower than what they were pre-COVID.
Yeah, look, the Armageddon's not going to materialise, but equally those numbers aren't real either. That's the reality, because the people in hardship are receiving support from their banks. They've all got, apart from the guys that have been restructured, they've all got until the 1st of April. Okay, so currently what's happened is APRA have allowed the banks to treat these guys differently. So they're not needing to necessarily treat them as non-performing loans in the banking system. And that's a very important thing to understand. So this dispensation that the banks are receiving in terms of the capital treatment of these loans then allow them to very firmly play on Team Australia, if you want, if you will. So they can then turn around and provide flexibility to borrowers. The 1st of April, what is not going to happen is you're not going to see a run and a significant increase in foreclosures, in my opinion, or our opinion as a firm, I would say also, because property market's too important to the economy, to general confidence and so forth. So there is going to be no situation where the system cuts its nose to spite its face. The problem will be managed, and we talked about the responsible lending stuff. We'll have loans restructured, you might have some haircuts given, you might have people put on interest only to push them out a little bit further to give them a chance to get back up and running. There's going to be a range of measures here that's going to stop that number exploding higher. But equally, the number that you see there is suppressed because you haven't necessarily seen those resolutions either, because look, at the end of the day, there will be some people that can't afford to stay in their home, that are in negative equity, that need to sell. So you would expect that number to rise, just as you would expect that small business bankruptcies, which are down on last year, will increase because these people are all receiving support currently. So what you will have is no question in that part of the market, you will have a greater level of default or bankruptcy than you saw last year. There's no question of that, but the number isn't going to be Armageddon-esque. Or it's not going to be enough to break the system, and the dollar amounts are not big enough to break anything. The fact is that the numbers that are concerning everyone are, the human numbers. It's the human costs. So if you're talking about 60 to 100,000 people affected, that's a lot of human beings. The dollars might not make any major bank unprofitable this year, but that's not always the point. There's a human side to this as well that we sometimes overlook when we just get stuck with the numbers.
Yeah. I just want to ask one more question, Andrew, on QE before we start having a conversation about consumer confidence and the, if you like, second and third order effects of that. My understanding with negative interest rates, essentially the banks bank with the Reserve Bank, if you like, and if the banks have deposits with the Reserve Bank and the Reserve Bank have got interest rates at negative rates, it's unlikely then that, this is my understanding, and please clarify and help me out here. Once the banks deposit with the Reserve Bank, and if you've got those rates at negative rates, it discourages the bank to be depositing money, and in fact, it encourages them to go out and then lend money, right?
Yeah.
How is that different to what is going on now, where rates are almost at zero and the Reserve Bank cannot force people to borrow the money? They can do whatever they can with interest rates and cooling lending requirements and restrictions and all of those things, but you can't force people to go out. And I guess that does lead on to the topic I want to have a conversation about, which is consumer confidence. Have I explained that right? Is that mechanically how it works, or it's how it's intended to
More
work?
or less. I think the spirit of it is pretty simple. You're absolutely right. You start getting penalised for doing nothing with an actual economic cost, which looks to drive borrowing. But, like at the end of the day, banks are made up of assets, liabilities, and equity, right? You don't have to keep those deposits. You can force those deposits back into people's hands or into another bank or under the lemon tree or wherever you want to put them, right? So the reality is that, yes, you're absolutely right. What tends to happen within banking systems when you get to zero is the bank compositionally starts to change its nature, okay? And what you start to see, if you look
And what do you mean by that?
well, you look at banks in the US and Asia and Europe, they alter what they do. So over here, our banks are very, very simple businesses, you take money from people and from the market and you lend it out, so the majority of profit comes from lending to residential mortgages and comes in the form of interest income. The non-interest income you receive is generally fee income that's, again, just related to the interest income, and then your actual income from things like trading and investment banking and investment management and the asset ownership in your own right is actually really small here. In fact, you've got banks like CBA getting rid of their asset managers or selling off chunks of them, right? While everywhere else on earth, the opposite's happening. So you have a look at the banking results out of the US. Most recent results spoke to enormous gains of their FIC book, which is fixed income, currency, and commodities. Right? So essentially, they're trading in rates, they're trading in credit, they're trading in other assets. It was actually a really, really big driver of profits. Okay, so that's what I mean, where there is a compositional change in how a bank looks to make money, and these banks are still generating returns of equity of around 9-10%. I mean, the good ones are. And our good banks do a little bit better than that. The monoliths like the CBA do a lot better than that by doing nothing more than lending out money and then a few bits and pieces hanging off the back of it. But what happens is, as rates go lower, and your back book becomes your front book. And what I mean by that is you've got all these legacy loans, people that aren't speaking to their mortgage broker or shopping around, when they realise where money can get to. Because to your point, if money is burning a hole in your pocket, you want to lend it out. So if you've got, so you can see that. So the interbank rate now, bank bills are at around 2 basis points. So there is too much money sloshing around in the system. So, again, you want to lend it out because it actually costs you money just to sit there. So where are residential mortgages going to get down to? Where's really, really good, cheap, really good, safe mortgage risk going to price? You could have variable rate loans on low value, on low loan to value ratios, price under 2 by next year. You could. I mean, someone will get there because they'll look at it and they'll go, well, you know what, the money's burning a hole in our pocket. We might as well do something with it. So when that starts to become apparent that those rates are out there, the back book becomes the front book, okay, and the net interest margin on your book starts to decline. And then what's happened historically, they pivot. And that's one of the impacts of low rates, negative rates. They start looking around going, okay, well, what else can we do? We'll start engaging in activity which holds a higher capital cost, okay, such as trading and other things like that. They get into things like asset management. So you look at JP Morgan almost as your archetype of bank, and has been until I think this year they're talking about making it, taking it off being the most systemically important institution on the face of the planet. You have a look at how a bank like that's composed and how it makes its money. It's very different to what we're talking about over here. Like our banks are almost like savings and loan type banks that are very, very simple by their terms. So that's what happens. The institution is increasing complexity. Okay, so the bank no longer just becomes about, what do I do with the excess money? I'm just going to lend it out. They start to become a bit more creative around how they're going to put money to the bottom line. So increasing complexity, a pivot towards non-interest income, and that's how the world changes.
How does that go with the whole concept of banks out now, getting rid of wealth management divisions and so forth, and talking about, we're going back to bread and butter, just lending out money to make our money? Like, how long is that going to last for?
Look, they're not on jet skis. They're captaining super tankers. And what you've got to remember is the short-term incentive scheme where they get their shares and options might be a year, but even long term for them might be 3 or 5 years at most, right? So when your long term is 5 years, you don't have to worry about what comes after 2024. It's not your problem, and there's always been a bit of that, right? So if you were acting with more foresight, what would it look like? You've got a guy like Shane Elliott there at the ANZ who clearly gets it and clearly speaks to the challenges and the disruption that is coming. Because even if you look at how lending has been disaggregated now, and you look at the example in the UK where open banking is becoming a reality, banking is going to get tough as a business. It's going to get really, really tough. So the being simple is really just built around maximizing the return on equity. Okay, so basically you want to lend to stuff that has a very, very low capital cost, which makes you the highest relative profit. And that, for forever and a day has been mortgage lending here in Australia, and will remain so unless the excess income gets lower and lower. But the question we all have to ask ourselves is, in an environment where cash rates are at zero, how sustainable are net interest margins of 1.5% to 2%? How's it possible that number stays there and isn't disrupted by guys that will come in, will not have a credit area in the traditional sense, that will use technology to underwrite, that will use technology to go directly to client and bypass mortgage brokers potentially, that will do all the stuff around underwriting the loan, using modules and apps, and even servicing for that matter. That business looks very different to what a bank looks like today. That business can probably do stuff a lot cheaper than that bank can do it, even though it's smaller. So the cost to income ratios these guys are going to run on might allow them to take lower net interest margins and could really complicate how this whole thing works. Now, when the return on equity of just doing banking ain't that great, these guys will then look at the fund managers they sold on ROEs of 9 or 10% because they were dilutive, because the rest of the book was doing 14%, and think, God, you know what? I wouldn't mind having that back right now. And this is how this stuff always goes, right? It goes in cycles. So, at some stage, they all go back to owning those kinds of assets. They just need enough distance on all the stuff that's happened over the last couple of years and that have obviously created a reputational impact and have really impacted, community goodwill towards them. And remember, bank boards don't want to take damage in those areas. They don't want the hazard that's associated with that side of the ledger at present. So, but
all swings and roundabouts, I guess.
Exactly.
What is the state of play with the banks now? How are they positioned financially? You talk about a lot of cash swimming around the system. What does that actually mean? What position are the banks in at the moment, Andrew?
Oh, they're fine. They're in a strong position. They've got the ability to absorb this COVID event in terms of how it looks to be manifesting itself. You look at the deferral numbers. We've got September numbers there. You've had Westpac and Bendigo have given a bit of additional colour in terms of where their book sits. But the number everyone's going to be focused on is, leaving deferrals aside, what percentage of the loan book after all is said and done is going to be in distress as of the 1st of April. And, the numbers there in the mortgage books will be somewhere between 0.7% to 1.5% to 2%.
So if investors turned a blind eye to between now and April or 31 March, is that what you're saying? And everyone's sort of
I think the equity prices reflect the fact that there's some concern. Equity prices reflect the fact that there's growing uncertainty, or there has been uncertainty around the dividends. So I don't think anyone's put a blind eye there. I think if anything, once people get comfort that the worst of COVID has been provisioned or even potentially over provisioned, I think people will start to build confidence that maybe that dividend starts to get paid again, and it changes the paradigm or the lens people are viewing those securities through, and that would be the same for any sector where they've been heavily discounted because of forecasting uncertainty around what tomorrow looks like, whether it's shopping centres or airports or airlines or casinos or what have you. I mean, as people get more comfortable where the numbers are going to end up, they can then start to infer what dividends or distributions might look like, and it puts them in a better position to analyse and value those securities. Okay, so I don't think people have looked the other way. I think if anything, probably the bigger question for me when I look at all of these guys isn't what happens over the next couple of years, because I think from an asset performance standpoint, I think in the short of the medium term we're absolutely fine, despite the fact that we've come through a very, very big challenge, and government support has been really important for the whole system in that regard as well. Make no mistake. But the threat of disruption to core profitability when we're 3 or 4 or 5 years out from now, and interest rates remain potentially very, very low, and business models are changing and disruption is increasing. What does that look like? What position the bank's in at that stage when it gets easier to move around?
Well, we're already seeing an emergence of lenders coming out, Andrew, especially over the last 12, well, even prior to COVID, an emergence of these lenders coming out lending to, whether it's property developers or whether it's to SMEs and corporates and so forth. What does that actually mean? Is that a short-term fad, or is that something that is emerging as a long-term, sustainable disruptor to the traditional big four banking tiers?
No, look, what you sort of find is for a long time. Look, the non-bank sector's been around for a very, very long time. They haven't just popped up yesterday. The only thing is,
but it hasn't been as great as it has been in the last last few years, I'd say.
Yeah. So look, I think when APRA sort of pushed the banks to pump the brakes on interest only and investor lending, for example, it gave a number of non-bank lenders an opportunity to grow their books materially. So they almost the banking system created this asset class known as near prime, which was stuff that they'd previously been willing to bank, but now was just sort of outside the because of these limits that had been imposed on them. And what that allowed the non-banks to do was grow their books materially. So the bigger non-banks are sitting there anywhere between $10 and $20 billion worth of assets, which is a really, really good chunk. So they're no longer the minuscule players they were. I think when we started our business with Rob Camilleri there in 2011, 2012, most of these guys were sort of sitting there at $2, $3, $4 billion in terms of assets. They've come a long way. Most of them have increased 3 or 4-fold, and then you've had new entrants like Latrobe who did their first public deal in 2014 or 2015, and within 5 years they've built a sizable program out of nowhere. And so not out of nowhere, I mean the business had run for 50 years, but you get that sense that whether it's them, the Peppers, Resimac, Liberty, First Mac, and then new guys like your Athenas, emerging guys like Nano, all these guys, the majority of them have been around a very, very long time. What's new is the guys that are emerging with new ways of doing things, where they are changing the paradigm on how you interact with the customer and how the loan is won. Or
can you give us some examples of that?
Oh, look, you've got guys like, and in terms of how money's conceptualized, I mean, Athena is probably one of the more prominent ones that a lot of people have sort of seen out there, where they're looking at that super prime part of the market, where they want to target borrowers that are absolutely prime, and they're willing to compete on price, because what they want to do is they want to build efficiencies in their business which allow them to compete on a stable footing with the banks. I mean, it's a really interesting idea to go after the breadbasket and go toe-to-toe with these monoliths on the grounds that there's a strong belief within these organisations that the incumbents are massively inefficient and have presented them with an opportunity. And then, the reconceptualisation of how money works, that groups like Afterpay and Zip have managed to put a spin on, traditional types of lending products. I mean, that's interesting too. So they're the real new forms of sort of disruption. And then you've got, non-bank lenders that have always been there and have gotten a lot bigger. But equally, those guys would be doing it tough at the moment as well, because it's hard to compete against banks that are getting money at 0.1. So this is the whole thing. So this is where they're going to face challenges over the next year or two as well.
Can we talk about what impact all of this has on people like you, people like me, investors out there who are trying to build their wealth, or others who may be on the verge of retirement and have retired at a point in time when keeping money in the bank and earning 6.5% on a term deposit is a mere distant memory now, because you're not getting that anymore. So Can you start to paint a bit of a picture, Andrew, around what all of this actually means for investors? What are investors doing, and what are some of the things that they should be starting to think about from your perspective?
Look, you know what they're going to do because, again, this is a well-worn path overseas. Savings rates will increase, and people's you just put you put it perfectly. People's ability to fund their own retirement gets heavily impacted here. So in a society like Australia, where we're an aging society, where people become accustomed to a nice quality of life with good income through employment, the bump as you get to retirement, it becomes very, very difficult to take. So what you're going to end up seeing is people will work later, longer in life, unfortunately, and the numbers are the numbers. So if your TD rate, if a good TD rate looks like 50 or 60 basis points right now, and you've got $10 million, imagine getting 50 grand of passive, not at risk income off a $10 million stack. So that's got you to the stage where you're almost needing to either take risk or consume capital, even at the top of the amount. And so what it does, it changes the provenance of risk. The risk is no longer the underperformance of your portfolio. The risk, and this has been done intentionally, the risk is now reinvestment risk. Not reinvestment risk, opportunity cost of you not doing enough with your money, because you not doing enough will force you to consume your capital. So go and do something, which then will, of course, increase other risks within your portfolio. And this is where it's a dangerous time for investors. And look, this is why we're big believers in the financial advisory function. We've spent a couple of years as a society hammering the people that do this job. But the reality is, given the environment we're now in, their role is going to be extremely important. And I think maybe it's, you could probably say that's probably the silver lining in everything the industry's gone through over the last 2 to 3 years, where no one can be uncertain around the impacts of being a bad actor in this space now. And that's really, really important, because as we go into what we're about to go into, good advice is going to be really, really important, because you're going to have to start to take risk, right? It's as simple as that.
It's the younger generation, though, that are benefiting to some extent from this, Andrew, where they can go to the bank. And you talked before about variable rates with a 1 in front of them. I mean, they're not too far away, because we're sitting, Athena, for example, is sitting, in the low 2s. I think financially, there probably isn't a huge difference between 2.16 and 1.99, but I think psychologically it gets people really curious and excited to see what that actually looks like. So I think from a consumer confidence perspective, that probably does a lot more to their psyche, more so than the bottom line. But it's the savers that have been absolutely clobbered since the GFC, because since the GFC, and I remember our clients locking in money at 6-7% term deposit rates. I remember fixing a loan personally at 7.5%. I thought I was a genius. And then look what happened after that. I had a 4-year fixed loan at 7.5%, and rates are tumbling down to 4.5%. So it's the retirees now that are copping it. What are you seeing in the space that you're involved in day to day, Andrew? What are investors doing with fund flow and capital? Where are you seeing that being directed towards?
It's interesting, isn't it? Once upon a time on the golf course, they were probably talking about the 3-bagger stock they bought. Now they'd be talking about the time they got a Bank of Melbourne TD at 4 or 5%, right? Go and tell your friends about that TD rate you got. So you're absolutely right. The world's changed. The dynamic is what I said earlier. People will take more risk. I think what happens is COVID happens right now. What you've got is you've got people, you've still got a lot of investors who are sitting there going, yeah, I'm still not absolutely certain what's going on here. So what you would have is you'd have people ready to act, but many have already started to move. All right. So I would say there's two groups. There's those that are likely to mobilise capital once they feel the environment is safe enough to do so. Okay, so I think that money is still sort of stuck at banks and sitting there not doing much.
What does that mean, though, the environment is safe enough to do so? No one's felt safe for the last 15 years.
Yeah, but look, I mean from the perspective that you can see what's going on with COVID out there. You're hearing the stuff about COVID deferrals. You've read something in the paper that this stuff ends on the 31st of March. You might have concerns around what happens as JobKeeper and JobSeeker and government subsidy starts to flow out. You just might not be overly confident around the outlook, right? So I tend to feel that there's still a lot of people out there that have the hatches batten down. There's probably just as many who have decided they're not going to sit there and just leave their money doing nothing, and have started to allocate it more broadly. And look, I think I can only speak to the growth in our business, but I think it's pretty common around most fixed income fund managers that we're seeing a lot more flow. So money is going into funds, is going into other assets where a pickup over the cash rate can be achieved for an incremental increase in risk, or a commensurate increase in risk as well, I should say. So, that's where people are sort of moving to, because they still need that 2.5%, 3% of whatever it is they need off that amount of money, or the corpus, which previously was the money that wasn't at risk. The change now is that money needs to be put at risk, and then the question is, how much risk? Where do you put it? And again, I think this is where financial advisors are going to be really, really important. This is where you have concern that clients end up in areas they shouldn't. Without naming certain prominent newspaper topics of recent times, where people have raised money on the benches for investments that get passed off as something as that they're not. That stuff would worry you to some degree. You don't want to see people get taken advantage of and hurt with so accessible, like tier one and hybrids, and other areas where people can just essentially get a reasonable rate. You might see something go into equity as people get more comfort around the fact that the worst might be behind LPTs, for argument's sake, or banks. You'll start to see people go back into some of these cyclical areas, and that's what I would naturally expect. So you're absolutely right. Income will become very, very important across the board, and then the assets that the people buy. So fund managers like us, we buy certain assets. As we get money through, that money then gets disseminated through wholesale markets into various debt assets.
Are you having to take on more risk, Andrew, so when you're managing other people's money, people come to, someone may have invested, let's say, in government bonds, for example, or term deposits. Let's start with term deposits. Then they move on to government bonds. I mean, in the hierarchy, that should be a little bit, they might have traditionally got more money from there. Then from there, they decide that they want to move into higher risk. They allocate some money to you, for example. Are you then having to take on more risk as well when you're managing investor money in order to generate a much higher return?
No, look, you don't want to do that, because look, at the end of the day, the cash rate's the cash rate. So the cash rate is our target, for example, is a certain number over the cash rate. In our high income fund, that number is 3%. In our income fund, that number is 1.5% to 2%. And in our strategic income fund, that number is 4.75%. Right. So the question for us is, how much risk do we need to take to deliver on our outcome over on risk when you're not being compensated for it, right? It's actually the worst thing you can do. So, right now we're finding opportunities in pockets where we can meet our outcomes without meet or exceed our outcomes without taking a disproportionate amount of risk, because we feel like there are a number of markets in credit that are still presenting really, really good value. Okay, and that's because they've been COVID affected and are now recovering.
And is that more so a relative comment, Andrew?
Yeah, it is more relative. So relative value is the real key focus for us right now. It is going to create challenges for bigger incumbents, right? So your larger bulge bracket traditional fixed income funds, where they have a large allocation to senior financial debt, like major banks, for argument's sake, because major banks have a lot of money right now. They're not going to necessarily need to roll over their existing debt. So compositionally speaking, there are going to be questions for these guys in terms of how they pivot and move their books, in the aggregate, because the index might change over a period of time. Compositionally speaking, their funds might change as well to meet these benchmarks or exceed these benchmarks. But because of the fact that the benchmark itself might actually alter its underlying nature. But in terms of what we're doing right now, no, look, just to be clear, one thing we really don't want to do is, if something used to pay you 5%, but now it pays you 2.5%, you don't go and take two times the risk you used to get the same number. The fact of the matter is, when you're an absolute manager like us, the one thing that gives us, the flexibility it gives us, is to basically stand aside on some occasions and decide we don't want to be as they say, the pig at breakfast. I'd rather be the chicken. I don't want to be committed. I just want to be involved sometimes. And then sometimes when the market pays you, well, then you lean into it. Then you take the risk because you're well compensated. The market is not implying high levels of complacency and so forth. So look, that's what will happen for a lot of people as the money flows in for us. We've with our main fund up until now, which is the Realm High Income Fund, we've started to communicate to all stakeholders that that strategy is no longer freely available to new advisory groups, as an example. So, we're trying to control the flow as well, because the more you get, the more you have to invest, and that can dilute existing holders, and it has impacted things like that as well. So, I think for fund managers like us, it's important to maintain discipline, be realistic around capacity and what you manage and how you manage it, and be able to sort of look through the here and now.
Andrew, I think there's what we're going through at the moment is really segregating those that are able to ride all of this, maybe a younger cohort who can take advantage of what is being encouraged by central banks and governments and the like. And then there's another cohort that really needs to start making some thoughtful and smart decisions with their money. Even though you may not be taking additional risk, investors themselves probably have to start thinking about managing their money slightly differently to how they may have been 5 or 10 years ago. And I really, the concept that you talked about, which was almost conceding that one may need to eat into capital, I think is something that more and more people probably need to just concede the fact. And, anecdotally, we're seeing a number of people realize property assets because it's just something that they have to unlock equity in, and just starting to maybe make some brave decisions that they may not have had to make until 5 years down the track, and fast tracking some of those decisions. So there certainly is a lot going on. I think investors are in a bit of stuck between a rock and a hard place to some extent. But I think it's those people that can start planning ahead and understanding the risks, creating margin for error if it does happen, and how they're going to manage their portfolios and investments. And I don't disagree with you. I think those that are getting good counsel, being challenged with their ideas, and either validating their ideas or challenging their ideas, the ones that will probably have the odds of success in their favor. Andrew, I've really learned a lot today. I could keep picking your brain on, as you call it, the plumbing of the system. But maybe we can continue the conversation. Just finally, you're writing a movie of what is going on in 5 years' time. What does the Australian economy look like in 5 years' time, according to Andrew Papageorgiou?
The world according to Andrew Papageorgiou, Papageorgistan.
Yeah, Papageorgiou films. What's going on?
God help all of you. No, look, the COVID's behind us. I think we remain in a malaise of sorts, where you're dealing with in many ways the same questions you were kind of dealing with going into late 2019, early 2020. Households are probably sitting there with a reasonable amount of leverage. Rates are constrained as a function of this. The level of confidence continues to be an issue. CapEx continues to struggle a little bit. Structural factors continue to present challenges for wages. Achieving inflation remains problematic. So in many ways, I guess I'm speaking to something where we recover from the worst of what's going on over here. But leaving in a vacuum with nothing else happening, no geopolitical flare-ups or anything coming out of left field, because again, you can just never see those things coming. But inadvertently, of course, they will come.
That's why they're risks, right? Because we don't know what they are.
Yeah, absolutely. You just can't see them coming. I mean, so leaving something there aside, I don't see how we change the game materially. I think what's sort of driving us are in many cases these factors that are fundamental. They're structural. And add to that, high debt levels, as I said earlier, really means that the script gets written in such a way where, again, as I said, difficult to create inflation. People will struggle to get really active for any long period of time. So, even confidence remains constrained, and you're talking about an economy that remains reasonably range bound, and at the same time, markets become more and more reliant in some way on central bank primacy if they could get any more so in truth, because that's
It
already
sounds
the
like
case.
you're describing what we talked about earlier, the concept of going down this path. There's almost no turning back. And it's just managing how carefully you tread down the path that you have chosen to go. Andrew, thank you so much for your time today. I really enjoyed our conversation. Thanks again, Andrew.
No worries, mate.
Cheers.
Thanks,
Bye-bye.
guys. Bye.